All right, so thank you all for joining again. This is the last section for today. And even if we cannot finish, I don't know if it's possible we'll do it tomorrow. I don't know. But let's try. Let's finish up today. Okay, let's finish up today. All right, so I was saying something. We're looking at what the hammer, we identified the psychology behind the hammer. It has a smaller body with lower wick and then little to no highs at all. Okay. And then we have what the shooting star and inverted hammer. All right. So the shooting star features a small real body at the bottom and a long upper wick with little or no lower wick, indicating a potential bearish reversal. Inverted hammer is similar, however, it suggests a bullish reversal. Okay, so inverted hammer and shooting star are similar. Okay, so a shooting star is still the same thing as an inverted hammer. All right, so it has what here it says what it has a real body at the bottom, okay, and a longer upper wick. Okay, so we are looking for candlestick that has small body, okay, at the bottom. So in this case, it's going to be a bearish candlestick, okay, and then a longer wick at the top, okay, a longer wick at the top, and then a smaller body. Let's see if we can identify them, okay. Let's see. Okay, something like this. Okay, this is a shooting star here. That's a longer wick, a smaller body. So this type of pattern is what we're actually looking out for. Okay. Let's still check out for others. It's not just only that one. But due to time, you can still personally go through it. Okay, you can still personally go through it. Okay. So the shooting star, it says the psychology behind it. Majorly what you need to understand is the psychology behind it. It has a smaller body at the bottom and a longer upper wick. Okay, with little to no lower wick. Okay, so this is, if you are to represent it on the price chart, this is the way it's going to look like. Okay, this is the way it's going to look like with a longer upper wick. Okay, with a longer upper wick and little to no body. Okay, and little to no body. So this is the way it's going to look like. All right, so it has a longer wick and smaller shadow and then a smaller body. All right, so that's the way it is. All right, so tweezer top and tweezer bottom. Tweezer top features two consecutive candlesticks with equal highs, suggesting a potential reversal. Tweezer bottom have equal lows, indicating a bullish reversal. Okay, uh, tweezer top features two consecutive candles with equal highs. Okay, so that is the psychology. The psychology behind it is it consists of two consecutive candles with equal highs. Okay, so let's see candles with equal highs. You can see them here. So this is a tweezer top. The highs are equal. The bottom here. Let's see for another example. This is a tweezer top. You can see here. This is also a tweezer top. It's more like a double top, but for candlestick. Okay, with a double top with candlestick, but for a candlestick. Okay, then for a tweezer bottom, we have this. Okay, you can see it's a tweezer bottom. Okay, double equal lows. Okay, this one looks like a tweezer top. All right, this is a clear example of a tweezer top. This here. Okay, so these are ways you identify patterns. These are ways you identify patterns. Okay, you need to understand the psychology behind the pattern. Okay, Then we have the evening and morning star. The evening star pattern consists of a large body candle followed by a small bearish candle or a bullish candle, and then a large bearish candle. Now, this is a psychology. A large bullish candle followed by a small bearish or bullish candle, and then a large bearish candle. So let's look out for it. Okay. A large bullish or bearish candle for an uptrend. Okay, so this is it. This is a morning star. Okay, let's see the morning star. It's a potential reversal. The morning star is a bullish counterpart. They are usually found at the end of a trend and usually signify trend reversal. Okay, so a large bullish candle. Okay, but for a bullish the reversal, thank you. For the reversal, it's going to be a large bearish candle followed by a small bullish or bearish candle, and then a large bullish candle. Okay, that is when we have the morning star. Okay, so this is a large bearish candle followed by a small bullish or bearish candle, and then a large bullish candle. Okay, then this is for the what? You see, it's for what? The morning star. Okay, the morning star formation, large bearish, small bullish or bearish, and then we have a bullish candle. Okay, and then for the evening star, let's see the evening star. We have large bullish, small bearish, and then large bullish candle. Okay, but remember, these are not standalone confirmations. They work in the direction of the trend. Okay, so you have to do it in the direction of the trend. Now, see another one here. A large bullish, small bearish candle, and then a large bearish candle. Okay, so the same thing formation almost occurred here. Okay, but this time around, you see here it pushed price up. You see the next candle formation that came pushed price up, but here it actually pushed price down. Okay, so you need to understand that if okay, now look at this guy here, the same morning star. Okay, a large bearish candle, small bullish or bearish candle, and then a large bullish candle, and then the next candle came large bearish candle. So you need to understand that in as much as this candlestick formation occur in the market, they are not stand-alone confirmation. You need to have them in confluence with what? Market structure and trend bias. Okay, so you don't get stuck in certain places. Okay, you need to have them in confirmation with trend bias. Now look at this particular one here. Now this one is giving me a bullish signal. Yeah, this one is also giving me a bearish signal. And why I'm not going to take these two, why is because just simply because my moving average, this price pattern is actually occurring above my moving average. Here this is the bullish signal to go long, but here now is actually occurring below my moving average. Now this one actually occurred and then it came back and then closed in line with my moving average. So this is a better entry for me compared to this and compared to what? This. Okay, so if I just combine it with this, and then I have my stop loss below here, and then I target a 1:2, I have my take profit field at this level here. Okay, so these are confirmations. That's why they don't just work on their own. Okay, they don't just work on their own. Trust me, they don't just work on their own. When you see them in confluence with support or resistant levels, okay, they work better off with support and resistant levels. All right, so here also it can also be seen as a previous support because price came here rejected. So most likely if price come back here and then print out that pattern formation you are looking out for, is a go for you. Okay, you can take the short and then have price deliver to the downside. Okay, so that's it. And then let's see Harami patterns. Okay, Harami patterns. Okay, bearish and bullish Harami patterns. All right, the Harami candlestick pattern is a commonly used technical analysis pattern that indicates a potential reversal or continuation of a trend. The Harami candlestick pattern consists of two candlesticks. For a bullish, for a bearish Harami, the first candlestick is a large bullish uh, rising candle, indicating a strong uptrend, which is followed by a smaller and a bearish falling candle with its body nested within the body of the first candlestick. Okay, the second candlestick is often referred to as the inside candlestick. The bearish Harami pattern suggests a potential weakening of the uptrend and a possible trend reversal to the downside. Okay, so let's see what we have here. Okay, so they said we need to have what? A strong bullish candle. Okay, just like here. Okay, just like here, we had a strong bullish candle, and then we had this nested inside the bullish candle. Okay, you can see this was more like a fake out to the highs, and then we had price delivered to the downside. Okay, let's look for another one without fake outs. Okay, um okay, so the psychology says we have for a bearish Harami, the first candlestick is a large bullish candlestick, indicating a strong uptrend, which follows by a smaller and a bearish falling candlestick with its body nested within the body of the first candlestick. Okay, so after we identify this, I'll just stop here so we go to the next one. I'll send you this manual so you can go through them, and then you can once you read them, you go to the chart and then you identify them easily. All right, so this is a strong bearish candle, and then we have this bullish candle nested inside the bearish candle, and then from there we have what? This upward move. Okay, so that's the way it is. Let's see, let's just see for more confirmation. All right, so this is a strong word bullish candle. We have a bearish candle. What it simply means for it to be nested is simply that the bearish candlestick closed inside the bullish high. Okay, the bullish candlestick, you can see this bearish candlestick closed inside this bullish candlestick. All right, so that's what it means for it to be nested. All right, so use this in confluence with what um support and resistance levels. Okay, so me personally, I don't really use the Harami. What I use majorly is engulfings. Okay, I love the engulfing pattern very well, very, very well. Okay, so let me quickly jump over to the engulfing pattern. We have the Marabuzu pattern. Now this is the engulfing pattern. An engulfing pattern occurs when one candlestick completely engulfs or covers the entire range of the previous candlestick, including both its body and its wick. This pattern is seen as a strong indication of a potential reversal in the current price trend. It can either be bullish or bearish. Okay. So let's see for engulfing. This is an engulfing pattern here. It covers the previous candle both with the body and with the wick. Okay. Why I love this particular candlestick pattern is because once you have it, you have it. Okay. This is an engulfing. It engulfs the previous body candle, both the body and the wick. Okay. Let's see here. This is also an okay. This one didn't engulf the wicks. Okay. Let's see here. This is an engulfing. It engulfs the previous body candle, both the body and the wick. Okay, this is also an engulfing here. It engulfs the previous body candle, both the body and the wick. All right. So, and now another thing you need to know is that there are times in the market where these things work. Okay, don't just do them anyhow. Not because you've seen them, then you say, okay, let me buy or sell. No, it's better you do them when the market is volatile. Okay, when you see that the market is volatile and it's moving, like during sections, during the New York section or the London section, at the best time you have better candlestick confirmations. Okay, so it's not something that you can just do anyhow. All right, because you see that because the market will always be in constant motion. All right, so there are sometimes you see engulfing pattern occur in Asian section. It doesn't really have momentum to push. Why? Because there is no volatility. All right, so you need to do these things when the market is actively trading. All right, when the market is actively in section. All right, so you can just go through this. These are three black crook and white soldiers. Okay, so that's it for candlestick. And then we have structural demand and supply. Okay, this is what will lead us to other blocks and certain institutional stuff. Here we have to deal with smart money and then SMC, those topic. Okay, so let's see. Okay, we're almost done. Let's see if we can finish this, and then we'll look at the Oxano strategy. Okay. All right, so structural demand and supply. Before we move to explaining our structural demand and supply concept, let's quickly explain what demand and supply is. Demand refers to the desire of buying, the desire of buyers to purchase a particular currency pair in the Forex market. It represents the level of interest or willingness of traders and investors to acquire a currency at a significant price. Higher demand for a currency leads to an increase in its price, while lower demand can cause the price to decline. Factors that influence demand include positive economic data, which we explained yesterday, strong market sentiment, which was also explained yesterday, and favorable interest rates, which we also explained yesterday. All right, so basically we've explained this whole stuff yesterday. Okay, when traders believe a currency is valuable and has potential for future appreciation, they will demand more of it. Okay, driving up its price relative to other currency. Supply. Okay, supply on the other hand represents the number of currency units available for sale in the market. It reflects the level of willingness of sellers to part with a currency pair in a given price. An increase in supply can lead to a decrease in the price of a currency, while a decrease in supply can push the price higher. Factors that affect supply include negative economic data, okay, weak market sentiment, and unfavorable interest rates. So the opposite thing that can cause to demand is what is going to cause supply, okay, an increase in supply. When these things that make price, these things that will make a country economy gain demand, when they are not there, it's actually going to cause to an increase in supply. Okay, so it's simply a situation whereby people are not willing to buy what you have. Okay, and you are producing, but people are not buying. Okay, so you have more produce down compared to people that are willing to buy. Okay, so there's no more supply than demand for a currency pair. Its price will likely decrease as sellers become more willing to sell at lower prices. Moving on, let's explain supply. Let's explain supply and demand a slightly different way as relating to charting. Supply and demand are two factors that determine any price in the Forex market or any market. Supply and demand trading takes place when a currency pair reaches a level of friction referred to as selling zone. This occurs when sellers decide there is a greater opportunity in selling at the inflated price. The opposite also happens when pairs fall at a lower level into a demand zone. In this case, buyer decides that there's a greater value in purchasing the currency pair. Okay, so this is just basic economic principle. Okay, so when price is at a low price, yeah, buyers are willing to take price up. Okay, and now when price is at a high price, sellers are willing to do what? take price down. Okay, so there are certain levels where buyers and sellers are actually interested in moving price. Okay, you can see here was a previous supply level, okay, or a previous resistance level that pushed price down. And then when price actually broke it and then came back down, we tested this level, a fresh level of demand actually came in, okay? And now this was as a result of what? A news event. You can see the massive demand that came in during this day, okay? So this was 8 o'clock. Most likely news that happened by 8 o'clock are most likely the FOMCs. Okay, so you can see here the massive demand that came into this market. All right, so regularly you may not really see this type of market move on regular price action. Okay, what actually influence this type of massive move are news events. Okay, news event majorly influences this type of massive demand in a particular country's currency. And then if you look back, you will see that price hasn't come back there over a long period of time, which is currently coming back to right now. Okay, so when the demand is over, when people are no longer in demand for the price, then price can now come back down and then find potential demand level again. All right, um so demand and supply zones represent a huge imbalance between selling order and buying order at certain price. This zone represents the movement of smart money. Okay, these levels are created after a huge number of orders are entered into the banking system, thus creating a significant imbalance between buying and selling orders. This massive wave of orders can be created by institutional fund firm, central bank, public bank, etc. Individuals do not generally have the buying power to make such purchase and influence the market in this drastic way. After the huge imbalance between buying and selling occur, as a massive wave of order is placed, the price returns, okay, the price runs away from the original level very fast and end up leaving many unfilled orders behind at the supply or demand level. Okay, what this simply means is that you see this massive move that occurred here, okay, it caused an imbalance. Okay, normally price will always move to fill up inefficiency. There's what we call inefficiency. Okay, there are gaps in the market where buying and selling must just balance. Okay, buyers should be able to be equal to the sellers. Okay, same thing with the sellers should be able to be equal to the buyers. Okay, then when we have this massive demand, it simply shows that there are more buyers in this particular currency at this time compared to the sellers willing to sell.